Hello, this is Solomon Davis, Right Side Trader. Today is October 2nd, 2023, and this is a continuation of me trying to help out one guy out there on trading options. This is all for educational purposes only. As we all know, trading is risky. You can lose money at trading. So please check with your financial advisor. Please check with your significant other and make sure trading is something that is actually suitable for you. All right, let's jump right over to the chart. Well, what I'm going to do here, I'm going to talk about what you should trade, when you should trade, and then how you actually execute the trade. As I said from the beginning, all I'll be looking at is indexes. And I'm not going to be looking at any individual stocks because all individual stocks have their own personalities. And it's easier for me to show you on, and I can show you on anything, but it's easier to try to focus on the indexes when you first start out trading. So this index that I'm actually going to be looking at is going to be RUT today, the Russell 2000. And I think I'm going to just stick with that one particular index. The reason why I'm looking at this particular what I see here on this index back here, as you can see during this year, how it just kind of went sideways. So it had tops and bottoms to trade. So on today's since we're going to be talking about bearish trades, when you want to trade the market going down, you need to have some kind of clearly identified tops. And with the Russell, you can get some clearly identified tops, believe it or not, and all. But nothing is 100%, nothing is guaranteed. These things can fake you out and all that. And mainly I'm going to be just looking at just candlesticks, and I'll leave my stochastic on here, and I'll leave my pivots on here, and yeah, I will do that. So, but when you're trading, when you are looking for a bearish market, the market needs to be going down. Let me see if I can bring up my drawing tool also. Let me see if that's going to actually work today. Let me see if I can find it. It should be right over here somewhere. There it is. All right, it's starting up for me somewhere. Well, like there it is. All right, as I said, what we should be looking for is something at a time when the market is going down. This is when you want to be trading puts. Like here on the Russell RUT. Here, as you can see, had a little down movement here, and we had a little down movement here. So you need to be in a market in something that's trading that has some kind of down movement, and you clearly you know you are in a bearish market. Ever how you want to see that, you watch some of my other videos. I talk about when we're in a bear market and when we're in a bullish market based on my plan and my trading strategies and all. But just to show you what I'm looking at is something that's going down like this. And right now, this may not be the best time to be trying to do a bearish type trade, but based on these charts and based on what I'm seeing right here, this is, like I said, for educational purposes only, to kind of show you what to look for. And this is what you're going to be looking for. You're going to be looking for a downtrending market. And I'll find you some kind of way of actually identifying that downtrending market. So the thing is, okay, when? So you have to come up, and I said I would use candlesticks again. I might try to put, if I can find that book or put a link, I'll put the title of the book in my description. I may not be able to find a link, but you can go out there. You need to do some work. Go out there and find a link, find this book, a PDF of this book. It is out there. I'll let you know that because I do have a copy myself. And it's a pretty good book, and I have read that particular book. And this guy actually have additional books and stuff. But let me zoom in a little bit here, and let's look at when you're going to be looking to take those bearish trades, and based on the way I like looking at the market, you need to start with a chart. The chart and the candles are going to tell you anything and everything that you need to know. Not anything and everything. It's going to tell you a lot and a lot that you need to know. I like starting here. So I'm gonna zoom in a little bit, starting back here at this peak here, because this is a pretty good peak, a pretty good candle pattern right here. And you can say, yeah, looking back. But again, you're going to get used to seeing this stuff happening. And this right here was kind of almost like an evening start. These three candle patterns here. I'm looking at three candle patterns here before that actually even happened. And if I back up, I know that doesn't move with me. Right there. So this is on a weekly time frame. That's the other thing you got to remember. You want to be looking at a higher time frame to actually execute when you're trying to identify what the market is doing. Because on that higher time frame, it's probably higher probability that it may follow through. But as we can see back here also, well, let me show you where I'm looking at. Right here was the same type thing, and it didn't work. You never got a confirmation candle. And this next candle was a doji, then this doji, and if you've been trying to play it to the downside with no confirmation, that's why you also got to get you some additional indicators to help you identify what's going on in the market too, that I won't be showing here. Also, if you want to learn more about that stuff, contact us here at Right Side Trading, and contact me, and we can see if we can help you. So first of all, what I'm trying to get you to understand, you got to identify what's happening in the market and have some indicators to help you see. At this time here, we can see the stochastic at that time wasn't quite at the top. So again, this really wouldn't have been the best time to actually take it. And back over here, we can see that the stochastic was at the top. The stochastic was making a crossover. So this would have probably a higher probability of actually following through. So that's what that's what you're going to be looking for in the market. I'm just showing you one example, but you'll see that this happened quite a few times. And what I'm going to do is scroll through here and see if we can see when this is happening. Because I said this is a product that actually does this quite often. And what I'm looking at, this right here, you had something here, but our stochastic wasn't all the way at the top. If you were wait for your stochastic to come all the way to the top, it would have worked well. If you was playing off pivots, I have monthly pivots on here. Monthly pivots. You could have played off of a pivot on a monthly high to play it back to the downside, and you did get confirmation to play it down. But again, that's why I'm saying you got to come up with your trading plan, with some strategies in it to identify when do you want to take that trade. And pivots is one of the things I like using. But it's one of those things where I like selling above instead of playing direction. But this directional trade would have worked out pretty good. But let's scroll on through the Russell here some more and see what we see. Now right here is the time when I'm going to be looking for it. You had a nice run up on the weekly chart. And I'm looking right here, and as you see right here, let me just circle this. This right here is a candle pattern. So you had this is what I look for when I want to take a trade to the downside. I see on a higher time pattern, I see a bearish harami. This is called a bearish, or this is called a harami here. Also, what I'm seeing with my monthly pivots, I'm getting my monthly high here in the market. It went up to that's a resistance 2 level, R2 level they'll call it, on a monthly. I would have saw that this thing was pulling back early in the month, and I did get early in the week, and I would have got confirmation on that actual pullback. So that would have been a good time actually taking a trade. This thing dropped over 100 points. The following week we can see. So now let's scroll through again, scroll through a little bit more where you get used to seeing the pattern that you want to see, when you're doing this. And let's see if we get any more up there. The stochastic didn't quite get to the top. That wasn't the best time. It did kind of play up underneath an R1 level You could have played it, but if you'd have played it here thinking, it was close enough, all again, based on your plan, your rules, how close it has to get to a resistance level in order for you to take a downward trade, and my stuff, I wouldn't have wanted to take that. Again, you almost got there again, at the end of the month, and then it rolled off. And the stochastic was close to the top, but not quite there. Let's see if we get anything else. All right, the stochastic is at the top. Again, now all I'm doing is looking for my bearish pattern. There's my bearish pattern, my bearish Arami. My stochastic is at the top, and I'll just one indicator, just candle patterns. You don't need a lot, and I'll then. Okay, I didn't get confirmation to the downside. I still got a green candle, so do I really want to take that trade at this time? Not really. Then I finally got my confirmation. I actually got where it actually closed below this. I was up here. The thing is, am I my early entry? Am I my late entry? Do I enter at 50%? Again, that gets back to your trading plan, your trading rules on what you want to do and all. And it finally gave you the big push down. It gave you that early warning that something was going to happen to the downside, and the stochastic and everything was in the right place, and it actually happened. And all. And then it's done. Again, it's down here. It's time to get out of your trade. The stochastic is at the bottom. You start getting a doji in the market. Get out, get out, get out. And then it actually started reversing back to the upside. Let's see if we get anything else. Up, we're getting there close again. It went almost to an R3 level, back into a zone that you may have created based on what you have seen before. You can take that trade early, or you wait and take that trade. Your stochastic is not all the way there. And now your stochastic is all the way there. You at a monthly R2 level, and it plays out pretty well. This was a bearish engulfing up here at the top at an R2 level, and it plays out pretty well with your stochastic actually following through for you. And let's see if we get any more. That's it. So that was the last bearish trade that we had in the market. I probably was saying sell your calls, buy your puts at that time. Now, since I showed you what to look for and kind of also when to actually be placing those trades, again, it's based on your trading strategy, your trading plan. Do you actually take that trade? And I'm looking at weekly candles. So you take that trade first thing in the week, end of the week, middle of the week, go down to your lower time frames and see actually what you see happening at those points to actually take that trade. Now, the key of all this thing, that's why I say the charts are the key. You got to learn to read the charts and see what's happening on the charts. But now to take that trade on this, we was looking at our RUT. Let me just show you right quick IWM, because we're going to look at IWM options. RUT options are cash settled options. You can play those, and but they're a lot more expensive. I'm going to show you that, but I want to also show you here right again. You're seeing the same type patterns. Here's that bullish Harami. Here's that bearish Harami. Here's that bearish engulfing. And here's those downward plays on those last two legs that I was showing you. Right now, we're actually getting a bearish engulfing here from last week. Unless this is the day. The day we're getting a bearish engulfing. But the thing is, it's also location. You want that location to be at the top. That stochastic to be at the top to show you that the market is at the top. Right now, it's showing you that the market is near a bottom. So do you want to take that bearish trade? This is when, it's all based on your trading plan, your trading strategies. Do you want to sell every pop? How people like buying the drops. Every drop, they like buying the dips. Here, you sell the pops. Excuse me, if you want to do something like that. Because you see that you are in a downward trend. It's all based on your trading strategy, your trading plan. What do you do? All right, so that's what you are looking for. This kind of you have to kind of like figure out the when you actually want to do it. You see the pattern. This is on a weekly time frame. Go down to a lower time frame and try to decide when do you want to sell that pop, and when you want to get into that trade going to the downside. All right, now the thing is trading options around this. There's plenty for every individual out there. There's a bear strategy that you can trade. With options, you can come up with 1,000,001. Probably not 1,000,001. It's quite a few. I guess strategies. Quite a few combinations that you can have with options and have a bearish trade. All I'm gonna talk about is two. One, buying a put. and the other one, selling a call spread. Buying the put is the one that your broker probably will allow you to do. Selling a call spread, your broker may or may not allow you to do that. What I also want to show at this time, I want to open up. Oh, I did the wrong thing. Where is it? Down here. I want to click here. And what I want to do is, you're not seeing exactly what I'm doing right quick. RT. And I am going to slide this over if I can, like this. And I want to bring this other screen over here also. Where is it? Boom. I really don't want that. Let me get this right. Let me minimize that. Minimize that. Click on this and slide it somewhere in here. No, this there. Why this thing keeps disappearing on me? Oh man. I don't want my game. Here, let me just this. And what I'm trying to do is show you the prices, the difference in prices on these two products. And I should have just popped that out. But let's look at this. Normally I said when you're buying an option, you want to be 90 days or more out. So we're going to stick with that. On RUT, and you're buying a put. You're buying a put too. What I'm going to do is go, I don't like a option. The thing is, we don't plan on being in this trade, to expiration. So buying an AM option is okay. So we're going to look at, I say 90 days or more. Let's just look at one here before the end of the year, monthly AM option here. And what I really want to try to look at here, let me change things up here. All we really need is that. And I'm going to do the same thing over here. Right here. And I want to do the same thing over here. I went with a 15th of December, and this one has the 15th of December, and I want to scroll this to where we see the prices and see things. Let's put it about right here. So this is going to show, this is 1/10 of what this is over here. So let me scroll this up a little bit more. Let me scroll this up a little bit more where you can see this. It's still probably going to be kind of hard to see. But what I'm really focusing on is price. The price of these things. We're both at December. We're looking at, that was my chair. We're looking at 15th of December, 15th of December. What I'm looking at, we're just kind of looking at the price of these options here right around at the money. It doesn't really matter. But what I want you to see, how the difference in price. These options are $6. These options are $60. These options are $50. These options $5. These options are $52. And remember, anytime you're trading options, you have to multiply times 100. So to buy one contract over here would cost you $600, where one contract over here, or at around the money, it's going to cost you $68,000. Just to get you on that. It doesn't matter puts or calls. Everything is going to have these high prices on them. So now, that's why, again, it's still all based on your account size, your trading plan, your trading strategies, how much you expect things to move. If you want to go ahead and spend that extra money, that $5,200 in order to buy your put, $5,200 in order to buy your put. As you can see, the width between the strikes are really not that bad up here, only 40 cents, and your move for today, already today, is $27. So you can still make some money on these trades and stuff. Again, it's just what you want to trade, how much you want to trade. And as you can see, the net change for the day on the downside, these things have made $9. So $9, that's times 100 times one contract. You know, you made $900 today if you kind of got into this thing Friday, or you got into this thing first thing this morning at the high and rode this thing down a little bit. But now let's look over here on the same product. And all, if you had brought one contract over here, yes, you spent 10 times less, and you made 10 times less. You only made $100. So again, if you're buying 10 contracts over here, say just this is all for education. Don't buy 10 contracts, unless you really know what you're doing. So you spent about $5,000, and you made $1,000, because it'd be 10 times that. It'd be like 10 times that, which is 10, then times 100 would be $1,000. So the money is going to be about the same. It's just how much money do you want to have at risk. You can granularly, you can get one or two contracts and spend, not quite as much as you would spend on the other one. That's the thing that I want you to be able to see here. So now buying, just how do you, again, I'm going through this basic like this because this is what happened to me when I first started trading. I didn't know how to buy, how to sell, and then what did it all mean? How much money did it actually cost? That's why I'm kind of going over the numbers and the whole cost thing. That's what this is all about. Because some people see this $5.46 and think that's all they're going to spend. No, you're going to spend $500 for one contract here. Over here, you're going to spend $5,200 for one contract and all. So that's what this is all about, where you can see the numbers, is where and you also want to know what to trade and when to trade it. And that's what I just went over first. We're looking at the chart. But now the numbers and all. So let's just say, and the first way to actually get bearish in the market with options, one way is just to buy a put. And we're going to buy, usually I say, the thing is, buying a put at the money is going to probably be it's the most expensive put that you're going to buy, because all the other ones are going to have some what they call there's intrinsic, where it has some value to it, and then when it doesn't have really any value to it because it's out of the money. On this particular platform, when you're below price on the puts you're out of the money. So this thing is trading at 173. So anything at 173 or below is out of the money options. And really they don't have any intrinsic value. They would be saying it's all extrinsic value. So that means I call it all fluff, But it really doesn't matter if you don't if your plan and what you see on the chart. As long as this thing moves, and the reason people like playing the downside of the market usually moves down, a whole lot faster than it moves up. So you have a couple things actually working for you. You're going to end up, if you're calling it right, you're seeing what's happening on the chart, and it's at the right time, and you happen to actually execute that trade at the right time before volatility goes up too high on you. You can get this thing at a good price when volatility is low. That's one of the things that you want to look for when you're buying an option. And the other thing, you're going to have to call direction right. So if you buy at volatility being low, you're buying it at a top, and it actually ended up being a top, and you get to see this thing drop. You get to see the market drop. You will see your option price actually go up, and it usually goes up pretty fast, because what's happening is as the market starts dropping, you start getting some panic, and you start getting the volatility goes up. Plus, you're getting market direction actually helping you. So that's the key why people get stuck on wanting to play the downside, because it satisfies that whole greed and emotional thing, in my opinion, that you see on your trades. Because again, you can make a lot of money real fast trading that downside. Doesn't happen all the time, and Russell is maybe not one of the best ones to do it, because it doesn't seem to drop as fast. It has some plunges down, but it can as you saw on the chart, it gradually goes down and actually really do make its way down. But now, buying a put. When you get ready to buy a put, you actually have to be on the put side. We're looking at puts. I'm saying being close to 90 days out, you want to give yourself some time to be right. I'm giving myself 74 days and all to be right. And then I have to decide, looking at the chart, do I want to buy at the money, which will be one of these two strikes? Do I want to buy out of the money? Based on what I see on the chart, where do I expect this market to go? If I'm not too sure about where this market is going to go, and I don't want it to turn into a full loser, I'm giving myself some time, and I see it's not working out, I can buy a little bit maybe in the money option and when I start seeing it's not working, I have my plan based on if I lose X percent on this particular trade, I know I want to be out of to save some of my money So this is the three places. I'm no trade recommendations here, I'm just trying to give you reasons why some people do what they do. Here, they have a target, a market target, and they want to play towards that. Here, they're more concerned about saving money. Although it seems like it's a little bit more expensive, but if you called it wrong, you won't lose 100%. And here, if you're buying at the money, you kind of like you're kind of like I say you're 51% that you're going to be right. Here you're leaning probably like you're really pretty confident if you're actually buying out of the money. So I'll say you're around 70%. This is just me and my opinion. It's me saying you're saying 70% you're going to be right. Here you may be 51% that you're going to be right since you're playing it to the downside and you're playing at the money, and these are the most expensive options. Here you're about maybe 45% that you're going to be right. If this thing starts going against you, you're going to be out of this trade like right away because this market, you're trying to catch that bottom. You're trying to catch that top, and this thing continues up on you. So as soon as you see it still continuing up, you're out of there, and you don't lose all your money. When down here, if this thing continues going up on you, you're going to lose all your money. And here, if it continues going up on you, you're going to lose quite a bit of your money. You can lose 50% of your money real fast on options. But when it comes to actually buying options, and volatility is up in the market, and volatility ends up dropping a little bit, it was just a little thing that just happened to be happening at the time, and you just called it wrong. So you end up getting out of that trade like right away. So now I'm going to go through the mechanics of actually buying the options and looking at a ticket. So when we're going to go with at the money, first thing you're going to want to buy on the axe, and you can actually put in a price anywhere between the bid and the axe. And our axe price right now is 516. Our bid price right now just changed to 512. So I'm gonna click here, and I'm gonna maximize the screen where we can see it. Let me minimize that and all. So what comes up is our order entry ticket, I call it. We're buying a single contract, not 10 contracts of IWM. Our expiration that you want to look at is 15th of December. And the strike that we're buying is an at the money strike, is trading for 513, 516. Our price right now is fluctuating right now with the market. I am looking at the live market. I am in a paper account, so me executing this is not a big deal to me at this time. And what you want to see, what I suggest, that you starting out, you do limit orders. When the market is this tight, it really doesn't matter too much, but you still will see you get some crazy slippage, even when the market is this tight based on the broker that you're with. Some brokers will honor, will give you a good price, and some brokers will just screw you, bottom line. Usually that, I can't say, is if you stick with any onshore brokers, you're going to be just fine. And most of the 90% of the onshore brokers, U.S. brokers, are not going to get you. You won't have any problems. I say 90%. It might be still a small percentage of them out there that you might. I don't know. I haven't tried them all. But right now, so once you verify everything here is correct, you hit your confirm and send on this particular platform, and then it brings up a confirmation dialog. You need to pay attention to this. It let me know that I am buying one contract of IWM. It let me know about this whole 100 times thing and all. It gives me my expiration date, the strike that I'm buying, and let me know that it is a put. It gives me the price and let me know that it's a limit order, and I'm opening a trade, so it's to open. It gives me a break-even price of the stock price if this thing actually starts going. That's kind of strange. Since I paid $5, if this market actually starts going down, that's kind of really kind of strange to me. That's really kind of strange to me. So let me just leave that alone. What's our maximum loss? If this thing with your maximum loss here, maximum profit, I don't even know if that's real either. Again, a lot of this stuff here, so because it can't go to the moon, number one. So how can you come up with buying a put? It goes to zero and all. So you have to go based on where it's trading at, and this thing actually goes to zero, multiply it times that, and that's how it comes up with a maximum profit price. Your maximum loss is the money that you actually spend on this and all. So your maximum, your cost, real cost, is that 517 plus your commissions. So the buying power effect, they're going to take this 517 out of your account, and that's it. And this right here is just what's on the account. So I do a confirm and send, and right now the market has moved. This put option has gotten lower. That let me know that the market is going up and is not going down. So we will not get a fill right now. So I will, if I really want to be in this trade, I just do a cancel and replace, and I'll change it. Right here we have a little lock on this particular platform to unlock it to give me what's up at the market, and I'll go ahead and just send it so I can see if it'll fill me. It just filled. And it says rejected already something. Oh, it had already filled it the first time I had put it out there. Let's look at this. And what account? I'm in this IRA account. Okay. So now I am going to do a right click on here and create a closing order. This is one of the other things when I first started trading. Okay, I had bought some stock and I didn't know how to sell it. So I'm calling my broker trying to tell him, okay, I need to get out of this trade. Please, I need to get out of this trade. I want to take my money. This is probably about right what I was saying. But he was looking for me to say, I have X number of shares of stock of blah, 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 sell, blah, blah, sell X number of shares at a limit price of XYZ, of whatever it was. That's what he was looking for me to say. But he didn't tell me that. I didn't know that at the time. So I'm just saying sell. I'm just saying close my. I'm saying sell my stuff. Let me get my money and stuff like that. And he gave me they gave me a hard time about me trying to close my trades. So at that time I realized it was stuff that I needed to know, stuff I needed to get trained on, and I decided, okay, started looking to get somebody to tell me how to do this stuff and all. YouTube wasn't like it was today. It might have been, but again, I wasn't on YouTube out there looking through YouTube, at the time. This was back in, I'm trying to say it was in the 80s, probably the 80s. Because we're still going, the self-guided trading thing like this was just beginning to come out. So it probably was back in the 80s, But now to show you how to do it, where you would know, As you can see, this trade is actually making some money right now. So I have to create my closing order. And let me do this, get this out of the way, get this out of the way. I really, you can see this down here. So we got into the market. First of all, on this platform, they show you the position. I can look at the position. I can see my average. I can see when I executed the trade, what I executed, 173 strike, the quantity, the price that I actually got in at, and all. And it shows me my open P&L. So for every, again, let's go back here. For every penny move is a dollar move on these particular trades. Because again, you got to remember you multiply times 100. Right now, we're actually losing money on this trade because the market must be going up and all. So we got in at 11 and it's at 4. So we at least it's there. It's at 5. So again, it shows you, and it's probably showing us a mid price of where the market is at. The mark. So it's showing you the mark. That's a mid price. So it's almost $5. That's about where we got in, and we're almost $5 down on this trade. So I'm just trying to show you ways of actually seeing what's happening out here. Now to create a closing order, what I'm doing on my position here is a few ways of actually closing this trade. One way is on the position, just right click, create closing order. I'm sliding over here and I'm clicking on that. And it brings up an order entry tool, an order entry ticket. And doing it this way, it's going to close whatever that position size is. Since it's only one contract, it know I have brought that. In order to close it, I have to say sell. So I have to say sell one contract of IWM expiration December 15, 2023. My strike price is 173. A put at $5 a contract, a limit order at $5, good for today. So that's what if I was telling them that and calling somebody, that's what I have to tell them. I have to tell them how to fill out this ticket and all. And then once I've told them all that, I got my price in. My price is now has dropped down to $4.96. I'm actually do a confirm and send. I'm making sure it's a limit order. And since I actually, the key is when you're buying a put, you got to think of when you're buying a put, when you're buying anything, you want to buy at a low price and you want to sell at a high price. Right now, we brought this, the price was higher than what we are selling it at. So this is we're gonna end up with a losing trade here. We're gonna lose a little bit of money on this trade, and that's okay because this is all for educational purposes only. No trade recommendations here. I'm just trying to show you how to do this on this particular platform. And ideally, you can go on this particular platform. There is education here where they also probably go over all this stuff here also. Now I'm gonna go ahead and do a confirm and send. It shows me all that. Again, it gets back to where what's important here. Make sure you're selling one contract, since that's what you had open was one contract of IWM, the correct expiration, the correct strike, the correct price. The money that you're going to actually get back into your account is this $4.96, what you're selling it for. They're still going to charge you commissions on this in and out at this particular broker, and that's what's important here. So I am going to do a send, and it just executed. So now let's go take a quick look at the monitor tab, and we're going to wrap this on up. As we can see, this is that put that we did. We just lost $14 in the market that quick. So that's how options kind of work. And on this particular platform, it'll show me my profit and loss for today on that particular position and that's what I have. Another good thing up here, you can go up here. You can see where you executed, trades and stuff. Different trades where you actually got in at. You got in at 511. You ended up closing this at 497. So the difference between that is the money that you lost plus commissions. So that's about that's $14. That's $14 plus commissions, which is another $1.30. So I hope this is being helpful. You know, it's a lot of just basic stuff, you know, but when you've never done it before, and you really need to go through actually clicking on the things and going through it yourself. You know, watching me is kind of good, but you actually clicking the buttons, seeing the stuff, and doing it, it really helps. And that's what you need to do also. Another way of actually, one last thing, this is going to always be up here. Before I actually close this trade, this buy order was here. Another way of actually closing these things is going up here and clicking on it. I did a right click on it and creating opposite order. Because again, if you have multiple orders out there of the same thing, maybe you want to close a portion of it and not close the full thing. This is one way of doing that, and it'll bring up this right here, the same ticket that we had before. Just wanted to show you that. Other than that, I hope this is being helpful. Again, this is Solomon, Right Side Trader. Hope you guys are having a great day. And coming up here, I'm going to show you that other strategy of actually getting bearish in the market. Call spread. Talk to you later. Bye.